Hi, my name is Josh Weszka from Vision Wealth Partners. Today's topic is about what type of business you are running. Are you a business value type company or a lifestyle company? The decisions you make ongoing can make a huge difference in the long term, especially when you exit. Determining whether your business is a value business or a lifestyle company kind of comes down to three things. First, the industry and marketplace in which you operate. Second, the personal financial needs of the equity owners. And finally, the ongoing business decisions made throughout its lifetime that will either determine larger value or financial independence in exit strategy. Managing income and profits, or what we also like to call EBITDA, which is earnings before interest, taxes, and amortization. While both is important in both style companies, one generates income to the business owners and is distributable. The other is a multiplier for the exit of the business. If the business owner's personal financial needs outweigh the incomes or EBITDA of the business, then the business is stressed financially. And if EBITDA is too low in a value business, then the exit or the marketplace potential will be decreased. Now we can move on to the balance sheet and talk about two critical components. First is cash, and second is cost basis. Why is cash so important? Let's take an example of business lending or banking. Very hard for a business to get started with banking solutions, whether you're a lifestyle company or a value business. A lifestyle company is going to drain their cash down year over year, which is going to make it harder for them to obtain lending. It will increase financial independence to the business owners, though, which is a positive. For a value business, they need lending to grow, so you have to keep cash on the balance sheet. By doing that, you're taking away investing power or growth of that asset long term, which then decreases the business value there as well. Juggling these decisions are critical and important over time. So now let's talk about cost basis. Both businesses, whether you're a value business or a lifestyle company, are always focused each year on tax mitigation strategies. Now, if you're a lifestyle company and you're trying to build financial independence, then you might not care about cost basis because you want to distribute the income to yourself, which is fine. But for your value businesses that are trying to exit, understand that cost basis, when returned to you, is returned to you with no long-term or short-term capital gains. And most likely, in the year that you sell, your taxable income reportable is going to be much higher. Having cost basis and managing that over time can help decrease that taxes on the back end versus trying to get your tax breaks up front. There are three ways we typically see a business exit. First is a lump sum sale transaction. Second, a transition or a sale to a key employee or family member. And last, you can just shut down and liquidate the company. A lump sum sale generally and mostly applies to our value businesses. And creating larger value is the most important thing. This requires a prioritization of time and financial resources into building human, customer, social, structural capital that ultimately generates 80% of the value to the marketplace in an exit. A transition to a key employee or family member can work for both types of businesses. For a value business and for a lifestyle company, it's very important that the business owners or the equity owners have some sort of financial independence of the sale of that business before they exit. Why is this important? There's a couple things to consider here. Usually when you sell or transition a business to a key person or family member, you usually have a long-term standing relationship with them where the sale price may not be maximized like in a marketplace sale. So that might lower the actual proceeds received at that point. Next, the buyout or the finances behind getting that sale done is most likely going to be either financed or seller-owned financed, which means no banking institutions and probably some sort of seller note. And in a seller note, there's a long-term commitment from the buyer to continue to pay that seller note back to the owners over time, which then brings in the last thing. The business actually has to continue in perpetuity long enough to maximize that seller note. All in all, the best thing to do is to create financial independence before an exit of this magnitude. That way, you're not dependent on the sale or the transition of the company. So the real question is, which business type is the best? Is it a value business or a lifestyle company? And as advisors, we'd say neither has superiority. But it really comes down to understanding your business in those three areas that we talked about earlier, which is the industry and the marketplace in which you operate, the personal financial needs of the equity owners, and then making those annual decisions ongoing to either create higher value or financial independence for that exit at the end. At Vision Wealth Partners, we continue to work with our business owners and new relationships, managing all aspects of their businesses to put them on the right path, paired with the right goals for their business and personal wealth accumulation over time.